Hello and welcome back to this week's vlog with me, David Jones and Trading 212. As usual, we're going to take a quick look back at what happened last week, what to look out for in the week ahead, and spend a bit of time on a trading strategy. This week we're going to talk about using moving averages, a classic trend following system. Now if you watched last week's video, I was saying that the important thing to look out for could well be what happens on the political front. That was completely right. Unfortunately, what happened was something of a surprise. The political events that many people were waiting for last week was going to be this weekend just gone, the election in France, the presidential election. But actually the political event that really moved the market was the surprise announcement from the UK Prime Minister, Theresa May, that there's going to be a general election in the UK in early June. And this really put a rocket under the value of the pound, particularly pound against the dollar. And that's going to be the market we're going to focus on this week, because it has had such a big move and broken some major levels. So we'll come to that in a few minutes' time. Before we talk about that, let's see what we should be keeping an eye on in the week ahead. Clearly, we have just had the French presidential election, so we could see a bit of volatility in the likes of the euro, European government bonds, and also, of course, the French stock market. But it's a really busy week this week on the economic front. US earnings season continues, so we've got plenty of data coming out from American companies about how well or how badly they've been doing over the last quarter. And this week, the focus shifts to the technology companies. So on Thursday, for example, we've got results from Amazon, from Intel, and from Microsoft. So again, that could have pretty major impact on the US indices, the likes, of course, of the NASDAQ, the S&P 500, and the Dow, those sort of things. But also on Thursday, we've got the latest interest rate decision from the European Central Bank. That gets announced 12:45 UK time on Thursday, with the press conference after. That tends to be the thing that moves markets. There are no changes expected to interest rates, but it's what they say in that press conference after that can really have an impact. And then on Friday morning, we have the first quarter's GDP, gross domestic product data from the UK, to see how well or how badly the UK economy has been doing in the first quarter of the year. And the expectation is for growth of about 0.5%. So it's a really, really busy week on the economic calendar. Then, of course, there's still all this political stuff going on in the background with the French election and the upcoming UK election. So we could still see, I think, plenty of volatility in the foreign exchange markets once again. But let's talk about our strategy for this week. Now, moving averages are, I think, a popular approach for many people, particularly when it comes to stock markets. I think medium and longer term investors, plenty of them will look at moving averages. But of course, traders look at this as well. So to find out a bit about the theory of moving averages and how we can use them, let's take a look at how it should work according to the textbooks.
Let's cover some basics of the moving average. Let's take our fictional market that's been trending lower. Now, let's say we're using a 20-day moving average on this market. So the price of the moving average today, the value of that moving average, that's the average price of the market over the last 20 days. So this gets plotted every day. So if the market's trending lower, then our moving average will be above the market price, because the moving average is taking into account higher prices from the past. Let's draw our moving average on. So here's our moving average following the market lower, so following the trend of the market, but staying above the market because the market is in a downtrend. Now let's draw a market that's turned the corner and is trending up. If we put our moving average on here, again, because it's taking into account lower prices from history over the last 20 days in this example, then it's going to be lagging underneath the market. So the moving average will have a lower value than where the market is currently trading if that market is in uptrend. So that's all well and good, but how do we get the signals? Well, at some point, if the market changes from being in a downtrend to being in an uptrend, then the market price and the moving average, our fictional 20-day moving average in this example, cross over. Let's see what that looks like. So the market's made a bottom here, turned the corner, the buyers have come back in, and the price has started to rise. But our moving average is a lagging indicator, so it will take a while to turn around. And the signal happens here. It's when the price crosses above the moving average. In this example, the price had been moving lower. Our moving average was moving lower. The price has turned the corner. So when it crosses above the moving average, this is our buy signal. And it's a simple price and moving average crossover. Of course, the reverse happens at the end of an uptrend. Let's take a look at that. So the market starts to turn and falls. When it falls below that moving average, that's our simple sell signal. Of course, this works perfectly if we have markets that just go straight up and straight down, and they'll cross through the moving average very cleanly and give simple, reliable signals. In reality, when markets chop around and are trading sideways, you'll get plenty of false signals. So this is one of the drawbacks of using a moving average. They're great in trending markets, but they'll generate lots of false buy and sell signals in markets that are going sideways. The fictional example we used here was a 20-day moving average. You can use whatever value you want, of course, but if you use sort of quicker moving averages, like a 5-day, a 7-day, a 10-day, they'll be much closer to the price on the chart. So they'll get you in to a new trend quicker than maybe a 20-day moving average, but they will be susceptible to more false signals.
Okay, so that's the theory of moving averages. Now, as we all know, it never quite works exactly perfectly in the real world. So to see how moving averages would have done, let's take a look at the pound against the dollar over recent months and the sort of signals that we would have got from that.
This is our pound against the dollar chart. It's a daily candlestick chart going back to September last year. Let's add our moving average on. We'll click on indicators up here. Now, moving averages are a trend indicator, so we'll choose trend and a simple moving average. And what I'm going to do, I'll stick with my 20-day. So it's the last 4 trading weeks is what it takes into account. Click on confirm, and there you can see our moving average line added to the chart. So you can see when the market is falling, of course, the moving average is lagging behind. When the market's rising, the moving average tends to be underneath the price. Let's walk through some signals. There was a brilliant sell signal back here, 15th of September last year, 2016. So the market had been above the moving average and fell below. And then over the course of the next month, we had that flash crash, of course, at the beginning of October. Pound against the dollar fell off a cliff. So that sell signal worked particularly well. Then it flips around here when the market moves up on the 1st of November. So it's saying close the short and go long. And this is where you see it can get a bit messy with moving averages. If the market is in a trend and then stops trending and just chops sideways, you can be, if you're watching the moving average during the day, sell one day, buy back the next, maybe sell again there. That's why many people, if they're looking at a daily chart, will want to see the price close through the moving average. So moving forward, we get a sell signal here on this day here, the 14th of December. Then again, a little bit messy. It closes above there, so you've been buying, then closes below there, you've been selling. And then the final signal, the most recent signal we've had for the moving average, which so far has turned out to be a good one, was back here the 9th of April when the price closed above the moving average. And of course, we know that the pound has moved higher since then. Now, if I change this chart to an hourly chart, here we go, and I'll scroll this out so we get a bit of a bigger view. So what we're looking at now, these are hourly candlesticks. We've still got our 20 moving average on, but obviously as we're looking at an hourly chart, it's now a moving average based on the last 20 hours. So you get a lot more signals, but of course, hand in hand with that, when the market goes sideways, like this period here, during the first few days of April, we have a lot of the price moving above, then below the moving average, generating false signals. So it can be frustrating, I think, just to follow moving averages on their own and not look for any other confirmation. But of course, when the market does start trending, like we had that massive move last week, we do have the moving average capturing the bulk of that trend. So as usual, it's not a magic system on its own that's going to be right all the time. It's good in trending markets. You just need to be aware when markets are going sideways, you'll have lots of false signals generated from the moving average.
Like I said, the big news last week was this shock election announcement for the UK, and we saw the pound up to its best levels in more than 6 months. So that's going to be the market that we're going to stick with now. It was a pretty major break when it rallied through the 128 mark against the US dollar. So does this mean that there are going to be even further gains to come? Is it a false break? Let's take a look at the charts and see if we can try and figure this out.
Let's start off with our big picture view of pound against the dollar. So here we go. We've got a daily candlestick chart going back around about 10, 11 months. And of course, the big move we can see here is June the 23rd last year, June the 23rd to June the 24th, when we had the EU referendum vote in the UK. All the polls were suggesting the UK was going to vote to stay in the EU, but as the results started coming in the early hours of the morning, it looked that actually maybe it could go the other way. So we saw a massive reversal in the pound, going from above the sort of 150 area, trading down as low as sort of 133 during the overnight session. Then we saw maybe a bit of stability over the next couple of days. The pound did slip a little bit lower, but seemed to find a base around about 128. So let's just put that level in there from early July. And I must admit, when we saw it trading sideways during the summer of last year, I was thinking, well, actually, maybe that's it. Maybe the worst is over and we'll see a more gradual recovery for the pound now. But those hopes were dashed late September, early October. We saw the market slip lower, slip below those old lows, and then go plunging on that flash crash day in October, the early hours of the morning in Asian trade, and it traded as low as 117. Now, since then, we have had something of a base that had been built, so sort of 117 down there, and those lows from January this year, let's put our lines on around about 120. So the market had been trading in a fairly wide sideways range for the past 5 or 6 months. That changed last week. Whenever we'd seen rallies up towards this old 128 level, so we've got one there back in December, and again late January, early February this year, we've seen sentiment turn around. So the market decided no, at 128, 127, pound against the dollar is too expensive. But on that shock election news last week, with Theresa May announcing that the UK is going to go back to the polls in early June, we saw the level break. So I think it's a really interesting one to watch now. Does this mark the sign of a change in sentiment for pound against the dollar? You know, if this is a valid break, then I think the next logical target for many people looking at charts, if they're looking at sort of a medium to longer term view, would be for a run back up to those post-referendum highs up around the 135 mark. So I think it's a really interesting market to watch over the next few days to see how it reacts now we've broken this level. But let's take a look at a more short-term view. Let's take a look at the hourly chart. So we've got the last month or so here, just going back to the last week in March. And there we can see, of course, that the sharp move on that election news. If we drew our trend line in off the lows from the 10th of April, you know, we do have a trend coming in around about the 126 mark. Now, after a move like this, it would not be surprising to see the market sell off. We've seen a really sharp move. And I think it's how it reacts on that sell-off that's going to be interesting. Is there going to be an appetite to be a buyer into any weakness? Because the market does think, well, hang on, sentiment has changed. So I think that the big level to watch is if we do get a sell-off over the next couple of weeks, back down to the maybe 125.50, 12600 area. Do we see the buyers come back in? But make no mistake, that breakthrough 128 is a significant one, I think, from a chart point of view. And many people would take the view, like we saw in gold a few weeks ago, where we covered on one of the videos in gold, that breakout through a previous high. These things are significant, but it's all about how does the market react now? Can it build on these gains? If it sells off, which won't be that surprising, do we see buyers come back in to push this up? So I think it's going to be a really interesting market to watch in the days and the weeks to come.
That's it for this week. With the economic calendar being so busy and people coming back after Easter, I think it does promise to be something of a volatile week in the days ahead. The pound is clearly going to be an interesting one to watch, but with all of these US companies announcing, we could well see some surprising moves for US stock markets and those individual shares. We'll come back and do this all again next week. If you like the video, click on the thumbs up at the bottom. If you click on subscribe, it means you'll never miss any of these. Next time around, we're going to look at moving averages again, but maybe a way of smoothing out some of those false signals. And as usual, if you'd like anything covered in the future, just leave us a message in the comments below and we'll add it to our list. But for now, we'll wrap things up there, and I hope you have a good trading week.